We recently published our Singapore credit outlook for the second half of 2023, and here are our key takeaways. Number 1, resilience of issuance volumes. In the first 6 months of 2023, we witnessed resilient performance in the Sing dollar bond market despite a volatile first half, with 8.9 billion Sing of new issuances priced through January to June. Considering that Housing and Development Board, a government-related issuer with deals that are typically large, was absent among Sing dollar issuers in the first half, this year's volume is comparable with first half 2022 levels and above first half 2021 levels. By comparison, year-to-date Asia ex-Japan G3 issuances were down 35% year-on-year per Bloomberg. Number 2, reluctance for long duration. With the hiking cycle in play for much of 2023 and markets plagued by periods of high uncertainty, there was a clear favoritism towards issuance within the shorter to belly part of the curve. There was no issuance in the greater than 15-year tenor basket aside from additional Tier 1 bank capital instruments, and no corporate perpetuals were priced in the first half of 2023. Number 3, retention of our first half outlook for the remainder of the year. We are somewhat close in sentiments now to where we started 2023, with continuing concerns on slowing economic growth, higher borrowing costs, and prolonged geopolitical risks. As such, the credit outlook for the next 6 months of 2023 is very similar to the one that we mentioned in January, but with some adjustments. Firstly, we continue to advocate staying short on duration, including the shorter part of the belly, as it continues to offer the best risk-adjusted returns. Secondly, given prevailing risks and recession concerns amidst higher for longer rates, we favor going higher up the credit curve. Number 3, we are turning neutral from underweight for long-dated high-grade issuers despite spread compression throughout 2023. Finally, number 4, we continue to remain neutral overall towards structurally subordinated papers, including perpetuals and bank capital, with some selective value given the recent sell-off. As for the outlooks for the major sectors we cover, we still expect Singapore private residential property prices to rise by 3 to 5% for the whole of 2023, despite further property cooling measures in April and driven by resident demand. We believe the increase in second half 2023 government land sales should alleviate the supply crunch over time and provide opportunities for developers that have been starved of land to refocus on property development in Singapore. For Singapore REITs, rising funding costs have had an effect on several fronts, including number 1, average interest rate coverage ratios falling considerably for the last 12 months to 31st of March 2023. Number 2, more caution over acquisitions, although there were some acquisitions in the first half from larger industrial REITs. And number 3, fewer Sing dollar bonds issued in the first half, with only 1 billion that were maturing, refinanced in the Sing dollar market. In Hong Kong property, the reopening of borders in early February and recovery of inbound visitors in April of 2023 has led to retail space rebounding strongly, with April 2023 vacancy rates improving to the average of 2019 levels. While retail space performance is expected to improve further in the second half of this year, the office space outlook remains dim amidst ample office space supply over 2023 to 2026 and the prevalence of hybrid work arrangement. Office vacancy and rentals are expected to weaken further in the second half and onwards. Finally, the first 6 months of 2023 highlighted how the interplay between key influences for financial institutions, fundamental concerns, regulator intent, and the structure of bank capital instruments can impact the risk-return profile for bank capital instruments. These 3 influences, along with prevailing uncertainty surrounding the interest rate and economic outlook, created heightened volatility for the operating environment of financial institutions and a crisis of confidence. We expect there to be lasting changes in the financial institution sector. And while this will likely result in higher credit dispersion in the future, it will create a sector more resilient to future volatility. This should strengthen the investing environment for bank capital instruments with selective opportunities for the remainder of 2023, particularly in more strategically important financial institutions that benefit from both scale and potential government or regulatory oversight or support. These institutions will be able to better accommodate a possible rise in regulatory requirements. We are no longer underweight on any sectors within the Sing dollar credit market. This is due to its relatively resilient performance so far in 2023, and that credit as an asset class can act as insurance against a possible recession. While value may be hard to come by given the chase for Sing dollar denominated papers so far in 2023, we think any potential drop in rates and credit spread widening will uncover opportunities for investors.